What are your thoughts on Nvidia these days, especially with the battle with Google?
Yeah. I think that in this market with demand this strong on kind of a secular basis, not cyclical, I think a rising tide is going to lift most boats. And I think there's plenty of room for Google to succeed with the TPU, for Amazon to succeed with Trainium, for Nvidia to succeed wildly with their chips, and also for AMD to participate. So I don't think it's what's good for TPU is bad for everyone else. I think it's more they're all succeeding, they're all growing significantly, and they all have a great growth outlook looking over the next couple of years as well.
You said, look, you're not really worried about an AI bubble right now. I mean, there's a lot of skepticism. You don't necessarily think that's the right idea.
Nvidia trades at 25 times earnings. If that's a bubble, it's one of the cheaper bubbles that we've seen.
Yes.
So I think that there's a lot of skepticism in markets. I think that there are constraints to this data center build out, whether it be chips over the last 2 years, power today. So no, I don't think it's a bubble. I think the demand exceeds supply, and I think that the hyperscalers are building data center capacity reasonably, prudently, and carefully.
What about Gemini 3 versus ChatGPT? I mean, we heard what Mark Benioff said. Everybody heard it, right? I mean, he's never going back to ChatGPT.
Yeah. I think that this is another area where the rising tide is going to lift a lot of boats. I think Anthropic is doing very well with Claude, especially with businesses. I think OpenAI is doing great with ChatGPT and consumer applications. And the Google model, Gemini 3, is off to a great start as well. I think they're all going to be successful. This news over the last week of ChatGPT declaring a code red made me think about 2.5 years ago when Google declared their code red in response to ChatGPT. That would have been a great time to buy Google stock. Obviously, OpenAI stock is not publicly traded, but I think that they're all going to be pretty successful. I think the market's plenty large and growing fast enough for all of them to achieve really good results.
Anthropic is a rival large language model, LLM developer that should not be disregarded, even though OpenAI is still one of the most powerful names in the AI space. Anthropic inked a multi-billion-dollar contract with Microsoft and Nvidia 2 weeks ago. Let's examine the specifics of Anthropic's collaboration with major tech companies and determine why this is a significant development for investors in Nvidia. Models like ChatGPT, Gemini, and Perplexity are fierce rivals of Anthropic's Claude LLM. Anthropic and Amazon have collaborated closely during the AI revolution, with Amazon investing $8 billion in the startup. OpenAI has expanded its exposure to a wide range of manufacturers over the past few months by signing new cloud and chip collaborations. Anthropic now seems to be following suit. Anthropic has reached an agreement to buy $30 billion worth of processing power from Azure, Microsoft's cloud infrastructure provider. Additionally, it has promised to hire Microsoft to supply up to 1 gigawatt of extra capacity. NVIDIA GPUs offer the majority of Azure's AI processing capacity. NVIDIA will provide clusters of its existing Grace Blackwell superchips, as well as chips based on its future Vera Rubin design as part of Anthropic's agreement with Microsoft. Microsoft has pledged up to an extra $5 billion to assist finance the acquisition, and NVIDIA will invest up to $10 billion in Anthropic. This collaboration with Anthropic may not seem like a big deal at first glance. I do see a few advantages, though, that investors might not be completely taking into consideration. First, the hyperscalers, Microsoft, Amazon, Alphabet, Meta Platforms, and Oracle, make up a large portion of NVIDIA's clientele. NVIDIA is less dependent on that tiny group of tech behemoths by acquiring Anthropic as a client. However, the deeper meaning of the agreement with Anthropic is more significant. This collaboration was announced soon after NVIDIA pledged up to $100 billion for OpenAI's 10-gigawatt data center project. The fact that Anthropic will be utilizing both NVIDIA's future Rubin processors and its existing GPUs is possibly the most profitable feature. Compared to competitors like Advanced Micro Devices, this kind of agreement structure gives NVIDIA a high level of revenue visibility and client lock-in. Now that Anthropic is a client, NVIDIA is providing more than just the hardware that AI models are constructed on. Instead, it is developing into a more comprehensive platform for AI ecosystems, creating the next-generation processors and providing the corresponding software that will be used to train and infer models over time. It's difficult to predict with certainty how much additional income and profit Anthropic could bring to Nvidia at this time. To avoid ignoring the actual money at risk, I would advise investors to stop worrying about the little things. Nvidia's valuation has increased over the past 3 years in tandem with large tech companies' growing capital expenditures. According to Goldman Sachs research, hyperscalers alone would spend close to $500 billion on AI infrastructure by 2026. Growing investments in AI infrastructure may be seen by investors as a sign of increased demand for Nvidia's data center products. Nvidia now has a rare chance to broaden its addressable market beyond the major tech giants, since Anthropic and OpenAI are starting to set the groundwork for their own extensive AI agenda. Since Nvidia's market valuation has already increased by several trillions due to the rapid investments in AI infrastructure, I believe the agreement with Anthropic could be a significant step toward the chipmaker's next trillion-dollar milestone. Without ongoing advancements in semiconductor capabilities, the significant developments in artificial intelligence, AI, that we have witnessed in recent years would not be feasible. To train new and larger complex language models, AI developers rely on data centers filled with the most cutting-edge hardware from firms like Nvidia, Nasdaq, NVDA. Graphics processing units, GPUs, and other AI accelerator chips are in greater demand due to the expanding use of AI and the rising computational requirements for AI inference. Although the business does not produce the chips it develops, Nvidia has benefited most from the increasing need for computing power. It packages and prints its GPUs in collaboration with Taiwan Semiconductor Manufacturing, NYSE, TSM. Strong financial results have also been achieved by TSMC as a result of increasing demand from Nvidia and numerous other clients. Over the past few years, both semiconductor stocks have grown significantly. Over the past 3 years, Nvidia's stock price has increased by over 900%, while TSMC's stock has increased by a respectable 250%. Nonetheless, investors ought to constantly anticipate a stock's future move. In light of this, which is a better purchase right now? Demand for Nvidia's industry-leading GPUs is unquenchable. Sales of the latest Blackwell platform were off the charts, according to CEO Jensen Huang at the company's most recent earnings report. In fact, the company's most recent quarter revenue increased by 62% year over year, reaching $57 billion. That demonstrates the significant hardware technology leadership that Nvidia has established. Its CUDA software, which makes it simple for developers to run thousands of Nvidia GPUs simultaneously, further supports it. Developers now have to pay a higher price for Nvidia chips than for more affordable chips from rival GPU manufacturers or custom hardware, which has resulted in hefty switching costs. For Nvidia's largest clients, who account for the great bulk of its income, the cost might be justified. In the most recent quarter, 4 clients accounted for over 10% of sales, or 61% of overall sales, according to the company. These clients are probably Alphabet, Microsoft, Amazon, and Meta platforms. According to reports, Meta is thinking of doubling down on bespoke chips by partnering with Alphabet to leverage its tensor processing units. All 4 are working on custom AI accelerators to replace their dependency on Nvidia. The major risk confronting Nvidia is the increasing usage of alternative chips by its top clients. As other GPU manufacturers and custom solutions catch up in design capabilities, its hardware dominance is decreasing. The stock is only worth 24 times what analysts predict for fiscal 2027, mostly calendar 2026. A large amount of the risk is already taken into account at that pricing. However, those projections could drop significantly if sales to any one of the main 4 clients slow down, and if Nvidia fails to meet analysts' expectations, its earnings multiple could be compressed. The stock can continue to rise as long as its largest clients keep expanding their data centers and equipping them with as many Nvidia GPUs as they can afford. The AI boom has caused Taiwan Semiconductor Manufacturing's market share in the contract chip manufacturing sector to soar as industry sales have increased due to the need for the most cutting-edge semiconductors. TSMC is essentially the only option available to anyone looking for the most sophisticated chip production capabilities, particularly if they anticipate large-scale manufacturing requirements. TSMC's market share has increased to more than 70% as a result. Its gross margin increased to 59.5% last quarter, while its sales increased by 40.8% year over year. Although revenue growth could decelerate to around 20% this quarter, management still hopes to retain that high gross margin. Due to the strengthening of the Taiwanese dollar in relation to the US dollar, October sales increased 17% on a constant currency basis. From the perspective of technology, TSMC's position as the top producer of sophisticated chips seems secure. In order to ensure that it can reserve the largest clients years in advance, it collaborates closely with businesses such as Nvidia to create the next generation of procedures. This makes it clear how much money should be spent on new facilities to satisfy demand. The company can invest more in research and development for the next generation process, guaranteeing it maintains its technological advantage because it generates significantly more revenue than its next closest competitor. Geopolitical factors pose the greatest risks to TSMC. It has managed to avoid tariffs imposed by the US government thus far. However, if a war breaks out in the area, Taiwan-China ties could interfere with its supply. In order to diversify its facilities regionally, TSMC has begun to open new foundries in Arizona. Investors appear to be taking such risks into account when pricing the shares, since the stock is currently priced at 23 times Analysts' 2026 projections. The decision between the two equities may depend on investor choice because they are both trading at comparable multiples of anticipated future earnings. Given its quick growth and analysts' long-term outlook for profits growth, Nvidia might have additional potential. Nvidia, on the other hand, is more uncertain because it has several sources of weakness that could have a negative effect on the earnings projections supporting its valuation. Additionally, there are increasing indications that its largest clients are shifting away from the GPU leader, and the competition is becoming comparatively more formidable. At this point, the hazards appear to be more pertinent. In the meantime, TSMC is probably a less volatile investment, even though it doesn't have the same potential as Nvidia. Although the risks have been a burden on the company for decades, it has successfully reduced them to the greatest extent practicable. Unless there is a catastrophic disruption, the company should be able to sustain very high earnings growth for years to come. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
When you start to see people get jittery about the AI spend, whether it's enough, whether it's too much, whether there's any real return, when you see the results out of Salesforce today, as well as some of the other companies this cycle, what does that tell you?
Validation movement. I mean, look at MongoDB as another one, right? And you saw with CrowdStrike on the AI side as well. Look, Remy, I think what you're starting to see here is the second, third, fourth derivatives. They're now playing out with the AI revolution. That's going to be the theme 2026. This is, I think, just more and more momentum, especially on the software use case side going into 2026.
This gets to this idea then. So when we start to talk about the adoption by the customers themselves, the clients, if you will, the companies that are selling this stuff, so whether it's whatever Microsoft's doing, whatever Salesforce is doing, does that ramp up or are they already at sort of warp speed on this?
Only 3% of companies in the U.S. have gone down the AI path. I mean, it speaks
only
to
3%?
our view.
Wow.
Only 3%. And it speaks to our view that, like, when you call this a bubble, it is way premature. Look, if someone like myself spends so much time, on the road, I just saw it in Asia for 3 weeks. Demand to supply is, 12-1 for NVIDIA chips. This hasn't even happened globally. And guess who's leading in the global race? It's U.S. is leading China when it comes to tech. So to me, the use cases now start to play out. The derivatives, the second, third, fourth derivatives are playing out. And that's the key. Look, that is the key theme that we're seeing from Marvell to Mongo to Salesforce, I believe to Snowflake and others.
I'm curious, too, just about on the chip side of this as well. We heard from Jensen Huang a little bit earlier today. He was on Capitol Hill meeting with senators, trying to address this issue with China and being able to sell there. Does China become a market for us, a market at least for U.S. companies at some point?
Oh, yeah, I think that's, you can talk about the Trump visit in April and then probably reciprocal here. It's a matter of time. We are not going to give that market to Huawei and take it away from NVIDIA and what I believe U.S. chips. And look, and that's what the godfather of AI, no one has a better perspective what Jensen's seeing. You don't want to give that market to Huawei and domestic competition. I think that's what's going to continue to play out in this arms race. That will be part of NVIDIA's growth story over the next 12, 18, 24 months. I think it's all part of this game of high-stakes poker going on between D.C. and Beijing.
I am also curious about the partnerships, and they continue. We did hear just a few minutes ago from Snowflake strengthening that partnership with Anthropic, basically integrating those Claude models deeper into the platform. Does that accelerate as well, Dan?
It has to, because in this arms race, that's what everyone's focused on. Put stakes in the ground, whether it's NVIDIA, OpenAI, Snowflake, everything Lisa Su's doing, AMD. Look, they could get criticism for it in terms of some of the circular financing and other issues. We're talking about $3 to $4 trillion that's going to be spent in the next few years. This is not the time to look at this from sort of the back seat. It's the time to be aggressive, and that's what investors want to see. And I think we are going to look out. It's why we think tech stocks are up another 20% next year. But the bears will watch this AI party through the windows. It's still 10:30 p.m. and that party goes to 4 a.m.